Welcome back to Happy Half Hour. I'm Nick Shermans. That's Toby Weber. Today is Tuesday, July 1st. We're talking about the last 30 days in markets, economics, current events, all that good stuff. This series, I've told Toby, and he doesn't know what I'm going to ask him, but I've told him that I'm going to stop being selfish. I actually put some effort into my questions this time because it's like 80-20, Toby asking me questions. I'm doing a lot of talking. We're going to flip that and put the spotlight on Toby.
I'm not sure how I feel about that.
Well, I'm going to chime in because some of these questions I have my own thoughts on.
You're asking me a question because you really want to answer it?
You know how most people ask you how you're doing because they really want to tell you how they're doing and less interested in how you're doing.
Makes sense.
Okay.
Let's go.
So I have to start with a headline that actually shocked me. So for those of you watching, if you've read any of my blogs or heard me talk, I'm a digital asset. I don't know if fan is the right word, but a proponent of digital assets like Bitcoin. Rick Edelman owns one of the largest RIAs in the country, and he is advocating investors put 10% to 40% in digital assets. I wanted to get your thoughts on that.
Yeah, it sure seems aggressive. Now, you're more of the digital currency proponent than I am, but that's not just anybody making that statement. Has been voted top RIA. So for someone like that, well-respected in the industry, to make that statement, it's a little bit surprising, if not shocking. If you just look at the numbers, and I think that's part of what he's looking at is how it's done since it started, and it's only gaining more traction, more institutional awareness, institutional following, institutional ownership. So I think for all of those reasons, he's saying if it works at 1 to 3%, why shouldn't you own 10, 15, 20 or more? Now, I might push back on that, but I think that's the argument. How did you interpret that?
He's saying conservative investors should own at least 10% in digital assets. And he's actually saying folks should look beyond Bitcoin, which may or may not have weight, but 10% for a conservative investor is pretty aggressive. And 40% for an aggressive investor is uber aggressive. And I think you have to balance this out. So I appreciate Rick. He's been very forward looking on the digital asset thing. He's been early, he's been right. But his audience is folks that are retired or about to retire. That's the bulk of their clients. And it's just a square peg in a round hole thing where perhaps owning a little in digital assets might be prudent, but you run the risk of tilting someone towards the risk of ruin if they're living off their portfolio. One thing about digital assets, it doesn't produce any income. I mean, that's a conversation for a different day, but it's just inconsistent with his audience. And I think he's probably saying these things to generate clickbait and to get people to talk about it, which it certainly worked. But I think 40%, 10% for a conservative investor is probably over someone's skis.
You could argue, in some of our portfolios, we own 10% in gold. So maybe what he's advocating is why would you own less of Bitcoin than you own of gold if they're both serving the same purpose? What are your thoughts on that?
I'll shelve the gold thing for now, but I will say credit to Rick, and I agree with him on this. If you have an advisor that refuses to acknowledge Bitcoin or digital assets, I think that's a bigger problem. And I would even go as far to say that could be a breach of their fiduciary duty, not specific to digital assets, just being open to new ideas. An investment portfolio in the 70s and 80s probably shouldn't look the same as one in 2025. So I feel like a lot of these older advisors that work for big banks, big Wall Street firms, they're just shut off to new ideas. And I think that's the bigger problem that Rick has tried to point out, as it relates to gold. Gold is a more traditional Bitcoin. And again, I'm big on position sizing. Like the merits of any asset class can change when you start to talk about extreme positions. So for gold, I'd say any one of our clients has a exposure from 6 to 10%, but that's not static. So we're running gold through our rules, and sometimes we own a little more and sometimes we own a little less. So I would say sizing what you own and then having a framework to make decisions is more important than perhaps the underlying asset. I've been loosely following the Oregon estate tax threshold changes that is in the legislature right now.
Okay.
Oregon is one of the least friendly states to die in because their estate tax threshold is $1 million, meaning anything over $1 million could be taxable at the state of Oregon level. Oregon is starting to realize that wealthy folks are moving out of Oregon because they don't want to die in Oregon and pay a bunch of money to the state. So there's all of these proposals going on where they could move the threshold from $1 million closer to 14 million which would be closely aligned with the federal threshold. The other proposal is moving the threshold up to 7 million, everything after that taxed at 7%. The last proposal is they would move it up slightly from $1 million and index it to inflation. I'm wondering if you have any thoughts on what Oregon is doing.
My only thought is good for them if they're actually recognizing the issue. And if people are moving out, we have clients that have adjusted their estate planning to reflect being residents in a different state, and in part because of the Oregon estate tax being quite onerous. So I think it's good that they're recognizing. I guess I would be surprised if they're able to push that through, because in an era such as we're in, where we're having to cut programs, cut dollars from a federal level, the state is not in any better shape. So signing up for that means you're going to cut money coming into the state, and I'd be surprised if that passes given our state's political siting.
They're targeting January 1st, 2026 for this to go into effect, which seems pretty aggressive, but I know part of what we do for clients now is several of our clients have estates well over $1 million, and they're thinking about how to mitigate or soften that estate tax. And there's various strategies, but a great one would be if Oregon just modernized what they were doing on the estate tax threshold side. Okay, I've got another question for you. So I'm kind of cycling through current events.
I see that.
Do you think the Fed is behind in cutting interest rates?
I would say you could make an argument that they're behind, but I think that you run the risk of some of the progress we've made on inflation. I think you run the risk of setting off a chain of events that make things worse 12 to 24 months from now. So I know Trump is pounding the table, stubborn Jerome Powell, calling him names. But I think whether we should or we shouldn't, Trump is going to get his way, my opinion, and that he's going to hire a new Fed chief and then put more and more pressure on Powell to cut rates. And the new Fed chief that he brings in is going to be brought in because he's going to cut rates. He's going to, follow Trump's lead. So whether they should or they shouldn't, I think the reality is rates are going to get cut unless something changes, over the next, 3 to 9 months. What are your thoughts?
I don't really have a feeling on this. I know the U.S. is behind other developed countries and emerging countries in cutting rates. So the rest of the world does tend to have a bias towards lower rates as inflation has come down. But when you look at asset prices, real estate, stocks, Bitcoin, all at all-time highs, usually the Fed isn't cutting in the face of all-time highs across asset classes. Usually the Fed cuts during a slowdown in activity. And we're really not seeing that. And, inflation is the boogeyman. The Fed has kind of used tariffs as an air cover to keep rates where they're at. But as I alluded to months ago, I think it was a misconception, and the media was making a big deal of this. And there's been a lot of talk about this, that tariffs are inflationary. And the last 4 months, inflation has actually come down. And I think that's one of the most underreported things. People are talking about inflation, but what's actually happening is prices are slowly coming down. And I talked about this in my market commentary. Consumers don't just blindly continue what they've been doing when the macro environment changes. If you're worried about your job, your wages, you're not going to keep spending money as you were before in perhaps a better time. So I think a lot of consumers are just pulling back the reins. And I think that's showing up in the inflation numbers. So the last thing I'll say is often thought that the Fed is a leader in policy and they're making these proactive changes. The Fed is very much a reactionary force. Markets can tip their hand or force their hand to do something. I always think back to the fourth quarter of 2018 when the Fed was hell-bent on raising rates. Markets went down by 20% in the fourth quarter. The Fed started cutting. So the Fed is very much a follower as opposed to a leader as it relates to monetary policy.
Well, and if you look at why Trump wants to cut rates, the two reasons I see: one, to juice or goose economic activity, and two, to make it easier to pay the debt that we have on the cut. Well, the problem is the debt. The problem isn't necessarily the interest rate. If you look at historically, interest rates are not dramatically higher than they have been historically. They're higher than they were the last few years. But, if you look at why he wants to cut rates, I think you can kind of better understand, what he's trying to accomplish. But inflation, you could say, is still above the target. And as you said, asset prices, house prices are still at or near all-time highs. So I'm not sure cutting rates at this juncture is necessary. He might prefer it, but I'm not sure it's necessary. But we'll see how things play out. I think he's going to get his way, sooner than later.
And to put a bow on this, the 10-year U.S. Treasury yield, I saw this chart, this is kind of a ridiculous stat, but since 1876, the 10-year U.S. Treasury yield is at 4 point something. Its average yield is 4 point something. It's right on its 100-plus year average. So it's not like rates are abnormally high or abnormally low. It seems like they're high because we just came off a post-financial crisis, 13 years of zero rates, which is abnormal.
So kind of stepping back a moment, and I know you just did a monthly video on this, but kind of give us your take on where we are on the market. We're halfway through 2025. It's, absent a 3-week stretch in April 2025. It was a pretty good first half of the year, but in the first part of April, we went down 17, 18, 20%, depending on the indice. And now we bounced not only completely back, but now the S&P is up about 5% year to date. So kind of give your thoughts on where we are today for maybe folks that didn't watch the market commentary video.
So the title of my commentary for the month of June was right back to where we started. So a lot of the same themes that I've been talking about for months, we're right back to where we started. And coming into 2025, I was saying the margin for error for U.S. large cap stocks, for big tech, for the S&P 500 was very, very slim because our starting point was extremely stretched. And we track future returns from that stretched level going back 100 years, and future returns from where we're currently at hover around zero. So as I said then, as I'm saying now, I think investors need to look beyond the S&P 500. The investment universe extends beyond 7 big tech stocks. You can own these names. We own these names, but revise your expectations down. One slide that I shared in the commentary series was the Mag 7, the big 7 tech stocks, are starting to act a little bit squirrely this year. And some say the leadership has changed from the early AI adopters or innovators to AI software, data centers, the energy grid. And there's some evidence of that happening. So again, I'm not saying you can't own these names. I would revise expectations down. The risk return profile going forward for the S&P looks less favorable than it did when the stuff was hitting the fan in April. However, most investors do the exact opposite. They hunker down during times of pain. Now we're getting questions, hey, should I own some of these AI names? Should we put this cash to work? The time to put cash to work is when it feels like you want to throw up. And I feel like we're right back to where we started.
Okay.
How about you?
It was an interesting first half of the year, and I think it's real easy to say, hey, we're completely out of the woods. We had the blip. We had the Iran-Israel conflict, and the market seemed to, absorb that. And so, hey, we're home free. We still have to resolve the tariffs and the trade issues. We'll have to see the impact on the economy. Obviously, if the tariffs were to go through and prices were to be raised 10%, that's going to have an impact on inflation. That's going to have an impact on corporate profits. So I think we just have to remain vigilant. We can be somewhat optimistic about the second half of the year, but it would be surprising to me if we didn't incur some volatility in the second half of the year, just as we did in the first half of the year.
In this July 9th date that people are talking about, I'm starting to get questions about this. Look, the market doesn't wait for July 9th and then start to react. The market is already sniffing out its expectation for what happens after that deadline passes. And right now, the market is saying, hey, we think that this is going to be resolved. There's going to be a good outcome. So this is the closest thing I'll make to a prediction, but the market's expectation is for a favorable trade result for our major partners. If there is some cracks in that, if it switches, if Trump sends out a tweet saying, hey, we're going to pull this, tariffs are in effect at 50% for China, that's when you have what actually happened, misaligning with expectations. That's where the volatility comes in. So that's something that I'm looking at. But right now, the market is acting like these tariffs are not a big deal. And the last thing I'll say is I track a lot of the sentiment and soft data. During the last podcast, I mentioned that the market is reacting less to tariff headlines. I did a search on a Google, like you can actually see search history, what people are searching in Google by term. And tariff really spiked at the first part of April. People were trying to research what tariffs were and how they could impact the market and all that stuff. That tariff search volume has cratered straight down. So not only is the media having less impact on the market with these tariff headlines, but people are less interested in tariffs, meaning the market is reacting less. Maybe that's head in the sand, maybe that's, reacting to positive price movements, but it seems like the market has moved on from the tariff headlines. And a lot of it is, it's used to the rhetoric now that the White House uses. We talk tough and then we kind of back off. The market is wise to that. And I think that's why you're seeing some of the positive moves in market and less of the crazy moves based on headlines. All right, so one thing that I think was a really good lesson, I believe went understated, was if you couldn't look how the market opened after the US bombed Iran, how would you think oil, stock prices, and the VIX would act?
Well, historically and just expectation-wise, you would think the market would be down 3, 5, 7%. You would think oil would be through the roof. You would think gold would be through the roof. You would think VIX would be through the roof. And I bet you're going to tell me that's not what happened.
This goes back to my expectations versus what actually happened. Again, it was always a possibility leading up to the weekend, and this was like June 20th, I believe, that the US could bomb Iran. The market was sniffing that out. US bombed Iran. The end result was less bad or better than expected than the market had been pricing in. S&P was up about 3% that next week. Oil was down like 12%. VIX cratered. So that's why I always say these geopolitical events are untradeable. Just because you think the market should react a certain way doesn't mean that it's going to react that way. It's a function of expectations. The market deemed that campaign less bad than what had been baked in, and it reacted in a positive way, in a confounding way for a lot of people.
So, it's an old adage that even if you have tomorrow's newspaper today, doesn't necessarily mean you can make money in the stock market.
That's right. Okay, the last thing I'll say. So this is more of a stat, get back to the soft data and sentiment, and then we'll wrap this up. So I'm going to read this. A Gallup poll from late this spring, 59% of Republicans were expecting gains for the stock market over the next 6 months versus just 12% of Democrats. That 47% spread between the two outlooks was the largest on record. React to that.
I think it's a function of Trump. I think it's a function. He is so divisive. And again, we're not a political podcast, but he is so divisive. People either think he can do no wrong or he's the devil incarnate, and there's no middle ground. Therefore, if you like Trump, you're positive on his policies, you're positive on what he's doing, you have a positive outlook on the market. That describes most Republicans. If you're a Democrat, you think that he's destroying the fabric of our country, he's immigration-wise and tax dollar support-wise, that he's destroying the country. And therefore, why would you be optimistic on the stock market going forward? He is, I believe, more divisive, more polarizing than any president. I don't think that's a very shocking statement, than any president we've had probably ever. I think that stat is a result of that. How do you see it?
I think it's, I don't want to say it's less about Trump, but I think it's more of a function of where we're at today as a society, how everybody mixes investing in politics. And they know they shouldn't, but they do, and they can't help themselves. And I always go back to what I can control. I'm just not big about worrying about what I can't control. What I do on a Tuesday doesn't really matter based on who's in the White House. Like, I'm focused on keeping my side of the street clean. And I think it just comes down to the toolkit that's required to be a successful investor in the digital age, where we all have laptops, we all have cell phones, we're all getting blitzed with information. You have to be able to block out the noise from the signal. And unfortunately, what we read on the news, what we see on TV is 99.9% noise. And when the market is going crazy, you're getting blitzed with headlines, it can cause you to do some stupid things. And I think avoiding stupidity sometimes is better than seeking brilliance. And I think an understated way to do that is just trying to separate your politics and investing and building a sound information filter and being very intentional with what you read.
Or hire a firm like Pure Portfolios that can help you behave during those times where you feel like you want to take some action. I think behavioral coaching is a big part of what we do, helping clients not make a terrible, significant mistake at the wrong time So I think that's a big function of what we do, and I got to put a plug in that way too.
And to piggyback off that, this is a major pet peeve of mine where, we talk to a lot of prospective clients. We've got our marketing funnel, which we don't have any salespeople. We've got our blog, our podcast. People find us, which is great. I talk to more people that are paying over 1.25%, own a bunch of expensive mutual funds. It's not tax efficient. They work with a big bank or a broker. There's conflicts of interest. They're working with a salesperson and they're worried about all these external factors. And I'm like, dude, optimize what you can control. You're lighting money on fire every year by working with these bad actors. Just look at the SEC most fine list and you'll see these firms on there. There's a more friendly place for your capital. In my opinion, it's a travesty that these big firms that do wrong by their clients work directly against them, manage trillions of dollars. So if you want to harvest the low-hanging fruit, work with a true fiduciary, an independent firm. If it's pure, great. If you just get your money out of Wall Street firms and big banks, that's great too. There's a lot of good firms out there, but there's more bad ones. And unfortunately, people gravitate to the shiny commercial, the social proof. Hey, this firm's been around for 80 years. That doesn't mean they're working in your best interest. Look at the publicly traded earnings notes to see how they're openly working against you. This is a major, major pet peeve of mine.
Well, and I think I'm always surprised when you have those conversations and you say, what are you hearing from your advisor? Oh, I haven't talked to my advisor. Like in the last month or two? No, I haven't talked to him in 6 months, 12 months. I haven't talked to him in a long time. So transparency is a big part of what we do. And a lot of times people don't even understand what's going on in their portfolio. They have questions, they have concerns, but they aren't able to raise them with their advisor because they don't have an open line of communication with that advisor. And to us, that just seems kind of silly.
It seems egregious.
Seems egregious. You're paying money for this advice, and yet you're not getting the advice that you're paying for. So I'll get off my soapbox now. But
okay, yeah. Sorry for the rant, but this is just a thing that's happening over and over again. So we're almost at a half hour. This is happy half hour. You can't go over a half hour. That's Toby Weber. I'm Nick Shermans. Thanks for tuning in. We'll see you next month.